Hey everyone, and don't forget to hit that notification bell so you don't miss out on any of our future deep dives. Today, we're going to be taking a page out of Warren Buffett's playbook and applying his famous value investing principles to a company that's been making some waves in the world of sports streaming, FUBO.
Yeah, FUBO is aiming to be that go-to platform for all things sports. They offer a wide array of live games from different leagues, plus, news and entertainment channels, all accessible across, your favorite devices.
They even have this cool feature. It's called Fan View. Lets you see live stats and scores while you're watching. Talk about an immersive experience. But before we get too caught up in the excitement, we need to ask the tough questions. Does FUBO actually have the potential to be a long-term winner? Does it live up to the Oracle of Omaha's standards?
That is exactly what we're here to find out. Now, the streaming landscape is already pretty crowded, with big players like YouTube TV, Hulu plus Live TV, and even traditional cable is still holding on. So what makes FUBO stand out?
Well, their focus on sports is definitely a key differentiator. They're catering to a passionate fan base that's willing to pay for access to their favorite games. And get this, there's data showing that ads on FUBO actually perform better than ads on other streaming platforms, and even linear TV, when it comes to grabbing viewer attention.
That's huge. That's a huge advantage. It means FUBO can potentially charge advertisers a premium, which could significantly boost their revenue. Think about it. In the advertising world, capturing attention is everything. If FUBO can consistently deliver a highly engaged audience, that's a powerful selling point.
Exactly. It's like they found the secret sauce for making ads actually work. Now let's get into the heart of Buffett's investment philosophy and see how FUBO measures up. One of his key principles is focusing on companies with strong long-term prospects. So what's the outlook for FUBO's future growth?
The streaming industry is definitely on an upward trajectory, but can FUBO keep pace with the competition and eventually turn a profit? That's the million-dollar question. They've been experiencing impressive revenue growth, but they're still operating at a loss.
Right. But there's an interesting wrinkle to consider here. They recently merged with Disney's Hulu plus Live TV. Could this be a game changer that propels them to the forefront of the streaming world? We'll have to see how that plays out.
It's definitely a development worth watching closely. Mergers can be tricky, but if they can successfully integrate Hulu plus Live TV into their platform and leverage the combined strengths, it could be a significant boost to their growth potential.
Okay, so we've got long-term prospects on our radar. Another crucial element in Buffett's playbook is understanding the business. How clear-cut is FUBO's business model?
Their model is actually pretty straightforward: subscription fees and advertising revenue. Plus, they have a high average revenue per user, ARPU, which tells us that people are willing to pay for their service. That's a positive sign.
Absolutely. High ARPU means they're generating substantial revenue from each subscriber. Now let's talk about the elephant in the room, FUBO's financials. Buffett is all about strong financials, and this is where things get a little more complex.
Their revenue growth has been impressive, there's no denying that. But the fact that they haven't turned a profit yet and have a fairly high debt-to-equity ratio raises some legitimate questions.
Before we dive deeper into those financials,
Yeah.
I wanted to remind everyone that we love hearing from our listeners. Head over to our YouTube channel and let us know which stocks you want us to analyze in future deep dives. And don't forget, all the sources we're using for this episode are linked in the description below, so you can check them out for yourself.
Now back to those financials. A high debt-to-equity ratio isn't necessarily a deal breaker, but it does suggest that FUBO is using a lot of borrowed money to fuel its growth. This can be risky if they're not able to generate enough revenue to cover their debt obligations.
So there's like a problem. They're playing a high-stakes game of financial Jenga. They need to be careful not to topple the tower.
Exactly. Now, another crucial factor in Buffett's approach is assessing the management team. He believes that competent and ethical leadership is essential for long-term success. What's your take on FUBO's management?
Well, on the surface, the team seems capable. Their CEO has a solid background in the media industry. However, there have been some significant insider stock sales lately, which can sometimes be a red flag.
It's true. Insider selling can raise concerns. It could signal that those with inside knowledge about the company's prospects are losing confidence. On the other hand, it could simply be a case of executives diversifying their portfolios or cashing out some of their holdings for personal reasons.
It's a bit of a mystery, and it's something investors should definitely keep an eye on. Now let's talk about valuation. Some analysts believe that FUBO might be overvalued at its current price. What are your thoughts on that?
Valuing a company that's not yet profitable is always a challenge. There's no crystal ball to tell us for sure what the future holds. Traditional valuation metrics might suggest that FUBO's current price is a bit ahead of its fundamentals. But it really depends on your outlook. For the company's growth potential,
It's like trying to predict the winner of a horse race before the horses have even left the starting gate. There's a lot of potential, but there's also a lot of uncertainty.
exactly. And that's why it's crucial to factor in potential risks. What are some of the things that could derail FUBO's success story?
Well, a major risk would be if they lose the rights to stream major sports leagues. Live sports are their bread and butter, so losing access to those games would be a huge blow.
Absolutely. And another concern is the ever-increasing competition in the streaming space. Could FUBO get squeezed out by bigger players with deeper pockets? It's certainly a possibility.
So to sum up, FUBO is operating in a growing industry. They have a unique offering for sports fans. Their business model is relatively straightforward, and their average revenue per user is strong. However, they haven't turned a profit yet, they have a significant amount of debt, there's been some insider selling, and their valuation might be a bit stretched. It's a mixed bag, to say the least.
It certainly is, and that's why we need to approach this investment with a healthy dose of skepticism. Remember, Warren Buffett is all about investing in companies that are fundamentally sound and have a clear path to profitability.
Now, before we wrap up our analysis of FUBO, I want to remind everyone that we're always looking for new stock picks. To explore in future episodes, head over to our YouTube channel and let us know what companies you'd like us to deep dive into next. We love getting recommendations from our listeners, so after all this, is FUBO a stock you should buy, sell, or hold?
Well, that's the question every investor wants an answer to, isn't it? And as we've seen, FUBO presents a complex picture. There's undeniable potential, but also some very real risks to consider. It's not a clear cut, yes or no.
So it sounds like FUBO is a bit of a gamble then.
In a way, yes. It's like a high-growth startup that's still proving itself, if their strategies pay off, and they achieve sustained profitability. Early investors could see significant returns, but if those risks materialize, the stock could face a downturn.
So what would Warren Buffett say?
That's hard to say for certain, but based on his principles, I think he'd likely approach FUBO with caution. He emphasizes investing in companies with a proven track record of profitability and a durable competitive advantage. FUBO is still working on both of those fronts.
That makes sense. He's all about those long-term, reliable investments. So what should our listeners do if they're interested in FUBO?
First and foremost, do your own research. We've given you a framework for analyzing the company, but it's crucial to dig deeper. Read their financial statements, understand their strategy, and assess whether you believe in their long-term vision.
And remember, never invest more than you can afford to lose, especially with a stock like FUBO, which carries a higher level of risk.
Exactly. And even if you're feeling bullish on EBO, diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes and industries to manage your overall risk.
This deep dive has been a fantastic example of how to apply value investing principles to a real-world company. Whether or not you decide to invest in FUBO, you can use these same principles to evaluate any stock that piques your interest.
Absolutely. Think about long-term prospects, a clear business model, strong financials, capable management, and a fair valuation. These are the cornerstones of sound investing.
And with that, we'll wrap up our FUBO deep dive. Don't forget to hit that notification bell so you don't miss our next episode, where we'll be exploring another fascinating company through the lens of Warren Buffett's wisdom.
And be sure to check the description for links to all the sources we used in this episode.
Thanks for joining us. And remember, this is not financial advice. Always do your own research before making any investment decisions.